Hey everybody, my name is Brandon with thestockstudents.com, and today I want to talk about Fubo stock, ticker symbol Fubo. What I want to do first is I want to hop into Google to try and explain my point of view on why I think Fubo is trading off nearly 50% lower than it was about 2 weeks ago. And then I want to hop into the earnings report to see how Fubo is doing as a business and see if it's investable. And then I want to hop into the trading charts to see if we can find a level or two to buy Fubo if we want to buy Fubo. So now let's get started. So here we are in Google looking at Fubo stock at a 1 month view. And as we can see, in not even 2 weeks, the stock has lost over 50% of its value. To me, that is absolutely mind-blowing. So the question really is, why did the stock have such a dramatic fall? Well, I've mentioned in past videos about a frenzy and parabolic phase here, and then some FOMO investors coming in here that both bid up the stock to these nosebleed valuations up here. I think the concept certainly applies to Fubo as well. And eventually, when people wake up to valuation concerns, then the stock starts falling, which scares investors who have already made a nice profit and causes them to cash out, which then continues the chain reaction down, down, and down. But another factor I think that could have contributed to the stock's fall, if we scroll down here, is this IPO lockup expiry that SeekingAlpha is reporting on here. So what an IPO lockup expiry is that before a company goes public, there's a contract that's made with inside investors that they have to sign that prevents them from selling shares up until a certain date. These insiders often have absolute boatloads of shares, so when the IPO lockup expires, these boatloads of shares are now able to go into circulation in the general public. What this does is that it dilutes current shareholders. Because owning a single share is basically your right to claim a teeny tiny bit of a company's profits, that right is now being diluted. Because now there are more shares in circulation, in this case, nearly 88 million shares. If we go into SeekingAlpha's article here, I've already highlighted that 88 million shares are now opened up for general trading. Now, I'm not saying that your average Joe or Jane is thinking about this or is what caused this stock to fall so dramatically, because this probably wasn't the straw that broke the camel's back. What I'm saying is that, just because this was an unfortunate headline and because the stock was already in free fall, the power of the negative headline was amplified and may have contributed to more downside for the stock. So if we go back to Google here, I think that's just one of the reasons why I think the stock could have fallen in such a dramatic fashion. Again, there are so many other reasons why the stock could have fallen, but the wake up to valuation and the lockup expiry are two reasons why I think the stock could have fallen. So now that we've gone through some reasons of why Fubo fell from Mount Everest, how about we talk about Fubo's earnings report to see how the company is actually doing and to see if it's actually an investable company. So here we are in Fubo's earnings report here, and let's dive into the revenues first as always. So this here is the most recent quarter, 2020, and this is the year-over-year view in 2019. As we can see, Fubo is actually growing revenues really nicely year over year. So just doing a quick calculation, this is a nice 11 or 12 times increase in revenue. And this is astounding for any company, and it's really good if you are an investor in Fubo. So now, I want to hop on over to this investor presentation here. So this is just a presentation that Fubo gives to its shareholders back in November. And as we can see, Fubo is growing paid subscribers nicely, nearly 50% year over year. Again, this is really great growth rate and fantastic news if you like Fubo and have skin in the game. Another point I want to make is that Fubo is in the right space for business for growth. As people continue to cut cable TVs out of their homes and they are choosing streaming services instead, Fubo is in that streaming service, which could continue to lead to growth. So now let's head back over to the expense report so that we can talk about the costs that Fubo is incurring. Because unfortunately, for all companies, we have to spend money to make money. So here we are back in the statement of operations, and this is the operating expense block here. So if we see, this is the total operating loss, and if we see year over year, we see an absolute explosion of costs that Fubo is incurring here. So, before I make a big deal about this, let's be fair and try to explain what this impairment of intangible assets and goodwill is, because this is such a huge portion of our expense. So what is this? This is actually an acquisition cost of Balto Sports. Fubo acquired the sports betting company, and the cost of that is what is labeled as this impairment of intangible assets and goodwill. I wouldn't really consider this as an expense per se, and I would kind of ignore it from the total operations cost, because this is just a one-time payment and it's an investment to get into the sports betting game. To drag this out a little further, I want to touch on the acquisition a little bit more. This acquisition is good if you believe that Fubo should go into the sports betting direction, but can be bad if you believe that Fubo should focus on its core streaming business. Again, you have to make up your own mind here to determine if this is a good thing or a bad thing, but in my opinion, I think the only way Fubo can compete or grow in the future, in my opinion, they need to double down on this combination of streaming and betting. The thing about the streaming space and Fubo is that we have massive competition. With Netflix, Disney+, ESPN+, these are all massive names and have nearly impenetrable name recognition. If you want to play the Fubo card, you have to be able to believe that Fubo, whose business is just a fraction compared to these behemoths, can disrupt the giants of streaming and wedge its way into homes across the United States. To me, honestly, I think this is quite a long bet and I don't think I want to make it. But again, this is your choice and your decision that you have to make. You just have to be aware of this. So now that I've gone on a long tangent, let's get back to the total costs here, total operating expenses, ignoring this impairment of intangible assets and goodwill. So I'll put the calculation up on the screen here of what I'm considering the total operating expenses is now. And we can see that with this $236 million ignored, we are actually seeing a 10 times increase year over year in costs. So this is actually not too bad because we see that our revenues are growing at 11 or 12 times. But now I want to focus on the bad part of the costs that I see here, and I'm going to badger on about the subscriber related expenses for a little bit. So I'll admit that I had no idea what this line meant at first, but after doing a little Control F searching through the earnings report to figure out what this actually means, I'll put up a screenshot here. But Fubo defines subscriber-related expenses as affiliate distribution rights and other distribution costs related to content streaming. Honestly, I'm still not exactly sure what it means, but my critical reading skills are telling me that these are the costs that Fubo is incurring to distribute the sports content to its subscribers legally. Basically, this is just paying for the rights to distribute the content. If I'm wrong and you know what this expense is, feel free to let me know, and I'll pin it in the comment section down below. But this alone is a huge red flag to me and is something that immediately turns me away from investing in the company. The main thing that I'm seeing is that this subscriber related expense is nearly scaling with the amount of subscriptions that we're getting. If this continues, then to me it doesn't really matter how many subscribers has now or in the future. If Fubo can't find a way to lower these per subscriber costs, then they won't make money because these distribution expenses are really eating into their profit margins. So now that we've gone over Fubo's fundamentals and the expense report, and I've explained the parts that concern me and excite me about Fubo, let's take a look at the trading charts to see if we can find a level or two to buy Fubo stock if we want to buy Fubo stock. So here we are in Fubo's trading charts here, and as we can see, we sold off quite nicely to this support level that it made before the stock broke out and started climbing to the moon. Because of that, I think we could stall from our free fall here and stop here around $28 for a day or two, but because the selling was so frantic and the MACD down here is still negative and doesn't show any signs of inflecting back upwards, I think the momentum of the stock is definitely enough to break this $28 support level and cause us to fall a little further. I don't think we'd make it all the way down to the support level here at around $15, but I wouldn't be surprised if we found some support between $20 over here, the top of this candle, and $25, which are the bottoms of these candles here. I think around this 50-day moving average, which is this blue line here, is a place that could help support the stock from moving downwards. But again, this is just a technical analysis, so it is not hard science, and the stock trends of the past do not predict the future 100%. These are just trends that investors have seen over the years that have worked for them and help them feel like they can better predict the future price action of a stock. So I think if you want to buy when the stock price touches this 50-day moving average, I think that the probability of safety is higher because we could see a short-term rebound in the stock. But again, this is just a technical analysis. So now that we've covered the main support and resistance levels here, let's just cover the other important indicators which I look at, which are the MACD here and the RSI here. So the MACD is a measure of momentum, and as we can see, the blue line is not really close to touching the orange line here, or is not bottoming out. If you want to learn more about what the blue line and orange lines mean, I have a link in the description to a blog post where I explain it. But if you want to trade using the MACD indicator strategy, you might want to wait until this blue line shows some sign of bottoming out or is about to cross this orange line here. When the blue line crosses the orange line, it means that the short-term momentum is stronger than what we are normally seeing in the long-term momentum, which is a bullish sign and may indicate that the stock chart could climb higher. But because we are not at that point yet, we could still have some downside for Fubo at the moment. Now, just to cover the RSI, the relative strength index is also an indicator of momentum, but it really becomes important when it falls below 30 here or above 70 here. If it's below 30, then the stock is deemed oversold. If it's above 70, then people say that the stock is overbought. It's not really telling me anything important because it is between 30 and 70, but the fact that it is still trending downwards may be a sign that we still could have some more downside for Fubo at the moment. So again, if I wanted to step into Fubo stock, then I would first be looking at this $20 to $25 range here. I think that would be a good range for the stock to wave out and for me to start accumulating shares if I wanted to go into Fubo. So that was my review on Fubo stock. Let me know what you thought about it in the comment section down below. If you have any other questions or if you caught any mistakes, also leave me a comment down below. If you liked the video, please like the video. If you haven't subscribed yet, please subscribe. And as always, thank you for watching, and I hope you have a great day.